You know when you see a company's sustainability report and there's some huge number, like millions of gallons of water used, and you just think, wow, that's awful. Well, what if I told you that that number all by itself is pretty much useless? Today, we are going to get into the one thing that really matters for understanding corporate sustainability: normalization. It's the only way to compare apples to apples, and we're going to break down exactly how it works.
So here's the game plan. First, we're going to see exactly why just looking at raw numbers can totally fool us. Then, we'll get into the solution, a kind of common language for sustainability. We'll even test it out with products you probably have in your house right now, and we'll uncover the one simple key that makes a fair comparison possible. And finally, we'll wrap it all up by talking about why this matters so much for investors, for companies, and yeah, for you.
All right, let's dive right into section 1, the comparison problem. We've all seen those shocking reports with these giant, scary-looking numbers. But here's the thing, the real problem isn't the size of the number itself. It's that without any context, that number can point us in completely the wrong direction.
So let me just ask you this to get us started. When you're thinking about environmental impact, does a bigger company automatically mean a worse company? Is it really that simple?
Okay, check this out. At a first glance, Megacorp looks like the bad guy, right? I mean, it's using 10 times more water, but look a little closer. Look at how many products they're actually selling. If you do the math, and don't worry, I'll do it for you, Megacorp uses just 0.1 cubic meters of water for every product it sells. Meanwhile, Small Inc. uses 0.2. All of a sudden, the bigger company is actually twice as water efficient. And that, right there, is the comparison problem in a nutshell. The raw totals just don't tell the full story.
So if we can't trust the raw numbers, what can we trust? Well, that brings us right to our second section, the need for a standard, a common language that everyone can use to report this stuff fairly.
And lucky for us, that common language is already being built by organizations behind something called the SASB standards. And get this, they're now part of the very same foundation that sets global financial accounting rules. Think about that for a second. Their goal is to make sustainability data just as reliable, just as consistent, and just as trustworthy as a company's profit and loss statement. That's a huge deal.
So what are they, really? Well, you can think of the SASB standards as a set of 77 different rule books, one for pretty much every industry you can imagine. And they guide companies on how to report on the sustainability issues that are most likely to actually affect their bottom line, which, let's be honest, is what investors really want to know.
And every single one of those 77 rulebooks is built on the same 5-part structure. They lay out what the industry is, they identify the key risks, and they specify exactly what to measure. But I want you to pay close attention to that last one on the list, activity metrics. Just keep that term in the back of your mind, because it is absolutely crucial for what we're talking about today.
Okay, enough with the theory. Let's make this feel real. We're going to zoom away in on one of those 77 industries, one that you've definitely got sitting under your kitchen sink or in your bathroom right now: household and personal products.
So yeah, according to the standard, this industry is all about cosmetics, cleaning supplies, soaps, detergents, you name it. We're talking about the companies making the everyday stuff we all buy, and they face some very, very specific challenges when it comes to sustainability.
So what are those challenges? What does the standard actually say these companies should be measuring and telling us about? Let's look at what gets measured, the metrics that actually matter.
The standard zooms in on a few key topics. For instance, water management is huge, which makes sense since water is a main ingredient in so many of these products. So they report total water consumed. Packaging, of course, is another big one. So they report the total weight of their packaging in metric tons. And for things like soap, the palm oil supply chain is a major issue, so they have to report how much of it they source. And just to put that water number into perspective for you, the unit they use is 1,000 cubic meters. Now, a single cubic meter is already 1,000 liters of water. So when a company reports just one unit of this metric, they're talking about 1 million liters. We are not talking about small numbers here. And that brings us to the absolute heart of this whole thing, the aha moment. This is the normalization key. This is how we take those massive raw numbers and turn them into something that actually lets us make a fair apples-to-apples comparison. So remember that term I told you to keep in mind? Activity metric. This is the secret, and it's really just a metric that measures the scale of a company's business. For the household products industry, the standard says you can do this by reporting the total number of products sold, the total weight of those products, or even just how many factories you have. This is the context, the missing piece of the puzzle we've been looking for. So here's how the magic formula works.
You start with that big, raw number, the one the standard calls a disclosure metric. In this case, total water consumed.
Then you simply divide it by that activity metric we just talked about, the number that shows the company's scale, like total units sold.
And what you get on the other side is an incredibly powerful normalized metric. In this case, water per unit. And there it is. This is how you compare apples to apples. You're no longer just measuring how big a company is, you're measuring how efficient it is.
Okay, so let's zoom back out for our final section. Why does any of this matter? Why should we care about this nerdy little detail about normalization?
Well, because having this normalized view honestly changes the game for everyone. Investors can finally make smarter decisions because they can spot true efficiency, not just company size. Companies themselves are held to a much more accurate standard, which pushes them to innovate. And for us, as consumers, it gives us the power to see right past those misleading headline numbers. It all adds up to a more transparent, more accountable economy, and that's a win for everybody.
And that leaves me with one last thought for you to take away. This idea of normalization, it isn't just for huge corporations. Think about your own world for a second. Your job, your industry, maybe even just your own household. What are the key activity metrics there? What are the measures of scale that would give real context to your impact? What would it mean to start measuring your sustainability, not just in totals, but in true, meaningful efficiency?